Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, in last week's show, I mentioned earnings season. So earnings season has just kicked off this week. So we're starting to see in the US, some of the banks announce their earnings for the quarter that was the period where most countries had a lockdown because of the coronavirus. So first up, we had Wells Fargo and JP Morgan. Now, interestingly, JP Morgan beat analyst estimates and they had a surprisingly good quarter, which was obviously very positive because the concern is that the banking sector is going to take a blow from the potential losses from loans because of the impact of the coronavirus. If you think about it, if millions of people are becoming unemployed, can't afford to pay their loans, then they will default and it's the banks that will get hit and their profit lines and their profit margins. So while JP Morgan actually surprised analysts, Wells Fargo, which is the fourth largest bank in the US, put aside £28 billion worth for potential losses due to loans. So that's £28 billion worth they had to set aside for loan losses in the future that could come about because of what I've described, the impact of the coronavirus. Of course, that was taken very badly by the markets. Their share price plummeted 5% in a single day. It started to drag down other banking shares. So as the week goes on, so this week we've also got Goldman Sachs announcing their earnings. We've got Bank of America. We've got Morgan Stanley. We want to see what's happening with these financial firms because they are obviously a bellwether for the economy. Now, if the market rally is going to continue, we would really like to see it not just driven by technology stocks. We want to see financials start to pick up as well because that would be a sign that the underlying economic activity was also picking up. So it'll be interesting to see how this plays out this week, whether the other banks outperform analyst estimates or they also have to set aside large sums for potential loan losses. So it's something definitely to watch and it could cause about the volatility in the markets. Now, mentioning volatility, we have seen quite a bit of volatility this week in equity markets, particularly in the US. Now, interestingly, we've seen a lot of volatility in the tech-heavy NASDAQ. Now, people are putting this down to basic profit taking because if you look at a lot of the tech companies, we've seen an extraordinary rally. And if you look at where they are compared to their 200-day moving average, they have rallied to quite extreme values. So we would always expect some kind of pullback. And in fact, the NASDAQ has had some of its best runs for decades in terms of consecutive days of positive performance. So we were always going to probably see some kind of pullback. And we saw that this week and it started to unsettle some traders. Interestingly, the Dow Jones started to outperform the NASDAQ. So we saw the S&P 500 get dragged down because those tech stocks still make up quite a large portion of that index. So that pulled that back. But the Dow Jones started to outperform, which, given that the Dow Jones seems to have a lot of exposure to firms that have exposure themselves to the underlying fundamentals of the US economy, it was quite interesting to see that it started to outperform. And some of that is because perhaps the banking earnings haven't been as bad as feared, even though Wells Fargo has lost $2.5 billion in the quarter as it was announced, but also because we started to see headlines around the potential coronavirus cure, or vaccine. So if you look at the share price of a company called Moderna, now Moderna have said they have a potential vaccine that's gone through a very positive first trial, and in fact it cause an immune response in every person in that trial. So the market loved that. So the market has rocketed in the last day or two. So if you can see that if you look at the S&P 500 or the FTSE 100. So we're seeing a lot of positive sentiment now in the US market. And what that means is that if there is a potential vaccine at some point in the near future, that's going to be good news for the wider economy, which will translate to being good news, particularly for things or for companies in the Dow Jones. The tech companies that have benefited from the stay-at-home work scenario obviously won't profit as much. So that's why you're seeing the Dow Jones outperform in the last few days. It'll be interesting to see if that carries on because it could be a sign of a rotation. We did see a rotation out of tech into some of the economic sensitive stocks, so things like financials, back in June, but then it reversed. So will this last, or have we just got a repeat of what we saw in June where we get a little bit of a dip and then the tech stocks start to take over again and start to push the market higher. You'll get some insight into the tech stocks soon, their earnings. So Netflix is going to announce its earnings this week. Going forward, we're going to see on the 22nd of July, we're going to see Microsoft and Tesla. 23rd, it's going to be Amazon and Twitter. And then on the 29th and 30th of July, we're going to get Facebook, Google and Apple, who are going to announce their earnings. So do expect some volatility as we lead up to those periods. But it could be, if the results are good, that the tech stocks maybe might push higher. Now, all this talk about earnings season, interestingly, it almost doesn't matter, because the thing that's really driving the market at the moment is the US Federal Reserve and the easy monetary policy. So the money printing, the low interest rates, and that goes for other central banks around the world. So that's what's really driving this market. Earnings season, we might see some short-term volatility, but if you look at the last decade, the lesson is that as long as the Fed has everybody's back, equity markets will keep pushing higher and will recover from any pullback. The fundamentals almost don't matter anymore, which is a worrying situation to be in. Now, if you look at the gold price, you can see the impact of the Fed on the gold price, because if they keep devaluing their currency by basically printing more money, then that means the dollar value is falling. And you're seeing that. The dollar is falling against nearly every other currency out there. If you look at the dollar versus the pound, now the pound has been rallying against the dollar, and it's largely because the dollar has been weakening rather than the fact that there's anything positive going on in the UK that's driving the pound higher. And that is because if the Fed keeps printing money, it devalues its currency. That is also good for anything that's denominated in dollars, and that means commodities. So if you look at the price of commodities such as gold, they've been pushing higher, and it's been in a bull market for a while now, but the gold price has been holding above $1,800 per ounce. And even though we've had a minor pullback of a percent or so, it's still been pushing higher despite this sort of euphoria that's started to build up in equity markets, that we might finally break out of this range-bound trading we've had in almost every developed market. If you look in the S&P 500, it's between 3,000 and 3,250. If you look at the FTSE 100, it's above 6,000. So we might finally break out above that. But of course, if there's a catalyst to the downside, which may be if the economy starts to pick up, that the Fed starts tightening its monetary policy, then that could also be a negative sign for markets, that the liquidity is disappearing and then the market could pull back. We've got a lot that's going on. Of course, we've got the American election coming up in the autumn, so that's another potential catalyst. And of course, we've still got the angst between China and America, and that's been ratcheted up again in the last 24 hours by Trump in relation to Hong Kong. So the market's sentiment is being battered a bit. It's got the positive sentiment from a potential coronavirus vaccine, then the negative sentiment coming from Donald Trump and his constant attacks on China. Now, if we look at bond markets aren't really buying anything that the stock market is saying. The yields have continued to push lower, so they're hovering around the lows that we've seen this year. So that means on the US 10-year Treasury, it's down towards 0.61%. On gilts, it's actually fallen below 0.2% as I speak. So that's all because of the economic outlook. And if you saw the announcement this week about the UK economic growth, then it was disappointing. So the UK economy hasn't rebounded as quickly as people had hoped. So that means that it's a good environment for investing in bonds, because it means interest rates are likely to stay low. And if interest rates stay low, that's good news for bonds generally. So we are in this market where we're getting mixed messages from haven assets that are still quite buoyant. We're seeing equity markets still quite buoyant. Can both be right? It's probably unlikely. So we'll have to see how that plays out. And finally, the last thing I just want to mention is another technical aspect. Now, on the S&P 500, the 50-day moving average crossed above the 200-day moving average. And now that's called a golden cross, which is seen as a very bullish sign. So it really is an indication that short-term momentum is picking up versus longer-term momentum. And it's seen as a sign that, as an indicator to perhaps buy the market. I'm going to talk about this more this week for 80/20 investor members about the reliability of that indicator. But it's another one that the bulls will be pointing towards as a reason to keep buying this market. So keep an eye on the news headlines surrounding vaccines, surrounding Donald Trump. Of course, coronavirus cases which continue to spike in a lot of states in America, and we're seeing lockdowns returning in other countries around the world. So the impact of that on the underlying economies will be important going forward. We've got earnings season continuing, so that'll be interesting to see what's going to happen there, if we're going to get any more volatility. So that is it for this week on Damien's Midweek Markets. As ever, you can get in touch via email, damien@moneytothemasses.com. Twitter is moneytothemasses with the number 2, and you can catch us on Instagram and YouTube. And don't forget to join our Facebook group at facebook.com/groups/moneytothemasses.